Well, I've interviewed Charles Nenner for many, many years. He always says, I know what is going to happen. I don't know why, because he uses timing models. And that's what I have developed as well as a timing model in my industry, the real estate industry. And it tells us that something is going to happen, tells us pretty much when, which is now, it's starting. And it doesn't tell us why. So we're left with that big question as to why. So let's just talk about what we're seeing, and why I'm saying this is that we are at the top. We've had this terrific market. We've gone through the accumulation phase, and we've gone through the here's the accumulation phase right here. Now it's really easy with real estate because it's 14 years up and 4 years down, and it's an 18-year cycle. So that's there's some vagaries in there, but that's typically what happens. Now, this is the accumulation phase. Then we went into the explosive phase, and we are here at the top. And this is a process. So the top is not a point; it is a time frame. And this takes a couple of years to transpire, and then a couple of years to come down, and then we bounce around here on the bottom, and then we start up again. But how did we get here? How did we get up here? Because we have to come down. If you notice, we're kind of wiping out what we've gone through, and this is called an excess. This is called the everything bubble, and no one seems. I keep getting questions as to why this is going to happen. But I've been through this. Would be the fourth one I've been through, and we get debt and capital destruction on a massive scale. So let me go to my next slide. Let's just talk about what I see. Here comes the why. Now, this is not an absolute. This is my attempt to say, here's just one of the things that are happening. So let's just go on and let's just talk about this. So I got this morning from Zero Hedge. We've all known this. I've talked about the liquidity pulses. But look at this. So Janet Yellen presided over $15 trillion in debt increase. $15 trillion. That is a staggering amount of money. You can see this here. I'm going to make it even better. But in the last 9 years, let's call it 10. Really, it's really about 9. But let's call it 10. Last 10 years, 42% of all U.S. debt ever issued, 42% of. We're in the country's over 200 years old. In the last 10 years, 42% of all debt ever issued was created during Janet Yellen's term in these last 10 years. So what do you suppose happens when you put $10 trillion into the economy? Like 42% of debt that's ever been put together. Now look at this is coming out of the Federal Reserve electronic data. We're talking about median home sales prices. Now you can see that we had a big bump. This is a huge, enormous bubble. This was the housing bubble. Look at this. But it didn't go very much. This went just a little bit of a bump and then down. And this was traumatic for the world. We just, in my portfolio here in Phoenix, of course, we have mentioned before, we were the poster child for bad real estate investing. And we got down here and prices just plummeted. Now, according to the median sales price, it was only about a 19% decline. But of course, real estate is regional. Phoenix got way beyond where it should have been. And it corrected because the markets don't like excesses, and they're always going to retrace. Here in my market, we lost 40-50% on many buildings. I even had one in my portfolio lose 70% of its value. Now again, I keep talking about the fact that we are income investors. We had no intention of selling this. We don't like to see the capital gains go away like that, but our income was never at risk. We kept getting at those rent checks, just kept coming in. And we got down here to 2008, 2009, 2010, and we were going nowhere. Right here is really about a 1.5 years. It just plummeted, and again, remember that real estate is sold on the margin. It is sold. So the last house sold sets the prices for the next of them. That's how we go up in value. You guys all love that. When you saw your neighbor's house selling for, $500,000, and all of a sudden your house is worth $5.25. Well, that's because the houses are going up. Now that happens the same thing on the way down. So we're going to witness that. And as prices start to come down, that's comps. They're setting prices on the margin, and that's happening for us, and that's coming. So let me go back to my slide here so we can just discuss this a little bit. Now, this kind of concerned the government. If you remember, Ben Bernanke came out and said the problem is contained in the subprime market, and we don't expect it to be any worse. It's contained. Well, of course, it wasn't contained, and it just kept plummeting. It scared the bejeebies out of the government. And what do the governments do when they have a problem? They do massive policy responses, a massive injection of liquidity. And this is where this exploded. So right here, we got a liquidity pulse, and it drove all this up. Now, this corresponds to this here, $6.8 trillion. Right here, you can see it right from 2010. Bingo, all the way to almost to 2018. $6.8 trillion was put into the economy. This is the increase. This is, and so when the government goes debt, they spend that money. They don't like put it in, lock it up in a bank. They spend that money, and that's what drove this. So you can see this right here. You can see it right there. It pops, and then it comes right back up. And then what happened? We had a scare. We had an enormous scare. We didn't know what was going on with this COVID virus. We got this madness that came across the world saying that we're all going to die. And of course, we didn't. But we shut down the world, and we needed to restart it. And so right here, we restarted the world. And that's this right here. You can see this in 20 and 21, $8.4 trillion that the government expanded. But of course, in the world, I'm sure there's more like $20 trillion, because every major market in the world expanded their debt and put tons and tons and tons of liquidity. And look what it did. It just drove the prices just right up, and it just drove it crazy. This is where you had the spending. This is where everybody thought they were just rich. If you remember the PPTs and the stimmy money, all of a sudden, look what it did to housing right here. Just look at this explosion, almost straight up. And then you can see my plateaus. And there's peak number 1 and peak number 2. Actually, it looked like we got peak number 3, but that's lower, and it's coming down just a little bit at a time. So this is where we're at. This corresponds to right here in the 2005 through 2006-07 bubble. You can just see it right here. That's the section right here. And I'm assuming we're going to do this, only from a much higher level. So it's going to come down. Now, if you've looked here, this came down to really like 2004 pricing. I think we're going to come down to probably down here where it started. And of course, it never stops where it's supposed to. I think we're going to come down to probably 2018 pricing. That would be brutal. That would literally be brutal. So now, can you imagine this? So let's play what if. Do you have a plan B? Now, I'm telling you that I think that we are at risk, because this is really, in my estimate, I think it's artificial. It's like someone who's never had a credit card, and they go out and find out that all they have to do is give their credit card, and they can have anything they want. And of course, they do. And it just goes on and on and on. And the government put out $17, $18 trillion in the last 10 years. And you wonder why the economy has been so good. Let me go to my next slide. Let's just talk about that. We open it up a little bit, because I want you to see these slides. This is pretty amazing stuff. So here we are. We're bringing this up. You can see this gray shaded. That was a very, very short artificial recession for COVID. We were due one. But this one, of course, was a doozy, because we shut down the world. And, of course, scared to death. No one knew what was going to happen. We shut down the world. Everything just came to a complete stop. And the government did what the government normally does, is that they flood the world with liquidity. And we got $8.4 trillion pulse. And that was here in the United States. You can see this. And of course, across the globe, it's probably $20 or $30 trillion. So it just exploded housing. Look at this, just exploded. This is because of all this money. You remember, rates were down. People had money. People were being sent. They were being sent stimmy checks. We had PPI. or PPP, and people were getting money and cash. And then all of a sudden, all this, remember, there is a little bit of a lag. So this money went into the economy and it just exploded the economy. That's what happens when you do this. This liquidity pulse is jet fuel. So when they just put jet fuel into a rocket and let her go, and that's what happens. And again, you can see here's peak number 1, peak number 2. Looks like we got a peak number 3, but it's lower than the others. This one here, of course, corresponds to the one we had in 2007, and down she comes. But why is that? So let me go to my next slide and we just talk about that for just a second. Now, we got this morning from Zero Hedge. This is Janet Yellen. Janet Yellen, who presided over a 42% increase in debt in our country. I am concerned about fiscal sustainability. I'm sorry we haven't made more progress. I believe the deficit needs to be brought down. Yes. What makes you think that, Janet? It's crazy. So now we've got, so she presided over almost $17 trillion. Just crazy stuff. So look at it. These guys weaponized all this. Now, we've talked about this. I've used this before. So on January 1st, you can see we were removing liquidity, and this peak really was peaked in, the second quarter of 2022. That's when we quit. We saw this happen, and my models turned red, and liquidity turned red. And you can see we had this big sharp drop, and away it comes. It starts coming down gradually. They're removing $100 billion a month. We're taking money out all the way down. And we get here to January 1st of 2024. Well, what's 2024? What's 2024? An election year. And of course, people vote with their pocketbooks. This is what sunk the Democrats this year. They had, prices of groceries just went crazy. Gasoline and groceries, and rent and utilities and all that stuff. Prices just went out of control. But they put money into the economy to make sure that everybody was working. Let me go back to this slide so you can see this. So here's the pulse. This was an engineered liquidity pulse, and it popped it. Excuse me. So you can see this small liquidity pulse, and we got lower rates, boosted the stock market, bankrolled the government hiring. I mean, the government was hiring like crazy, and now we find out that we've actually lost 750,000 jobs because the government wasn't telling us the truth. So these are the things we kind of have to find out ourselves, because in Federal Reserve electronic data, we get the real data. We don't get the narrative. So let me go to my next slide. So here's the question. What do you think is going to happen when this stimulus is removed? And look at this. This just happened. So we have the election. Again, $624 billion in deficits being spent for October and November. Again, right in front of the election. They're just boosting this thing. They're just really goosing it up. What do you suppose is going to happen? We've been spoiled. We just had all this money, liquidity everywhere, and the government is spending. Who's getting this money? Excuse me. Who's getting the money? We're spending trillions of dollars. Here in 2 months, we saw the government. The Biden administration spent over $600 billion. Well, that goes to somewhere. Where did that money go? Even if it went to Ukraine, they're buying things with that, and of course that stimulates the economy, right? It also gooses the gross domestic product, the GDP, because when you have gross domestic product, you add in the deficit. So if you're running a 6% deficit, that gives you a 6% GDP. But our deficit's been running our GDP's running like 2.5%. With a 6% deficit. Well, that means the real economy is running like a -3.5%, because you add in 6 to a -3 gives you 2.5 positive. And this is how this narrative has been hid, and we're just having trouble with this. So what does this mean for us? What exactly is going to happen? Now, we've had stimulation to this economy like nobody's business. What is going to happen? Let me go to my next slide. Let's just take a look at this. What do you suppose is going to happen when we remove the stimulus? And it's going to be removed. These two guys know exactly. These are business people. They know what happens when you spend outside of your ability. What do you suppose is going to happen to this? This is the why, guys. This is the why. I'm talking about why is this going to happen? I have all these comments because my timing model tells us what. Now, this is a why. Why do you suppose this is going to happen? These guys are going to come along and they're going to take out all this excess spending. They're going to take out trillions and trillions and trillions of dollars out of the economy. And you know how that economy got goosed up? Because we had all this excess liquidity that was going into the economy. You know how everything was just going crazy? Remember in 20 and 21, everybody thought they were the smartest people in the world. The stock market was doing well. The real estate market was doing really, really well. The economy was going. There was money for any project that you wanted. What happens when that jet fuel is gone? What do you suppose is going to happen? Let me go to my next slide and let's just talk about that. Because this is coming. Debt and capital destruction on a massive scale. That's this side, guys. Remember how fun this was? I told you this is everybody's partying. I'm going to cocktail parties and I'm in the real estate business, and everybody at cocktail parties tell me how smart they are because they've been buying these properties, and the property they bought it and like 3 weeks later, it's up $25,000, and I'm thinking, oh my gosh, this is really smart. Well, now we're going to come down here. This is my model. It's saying we're already peaked, guys. We're coming down. And you know that famous saying that Hemingway, how did you go bankrupt? Slowly at first, then all of a sudden. That's what's going to happen here. And I think we are going to pay the piper, because we are going to have lots and lots of jet fuel taken out of our economy. And it's already happened in the commercial. So the commercial went into this almost a year in front of us. We could see that they got a peak. Remember, we peaked in second quarter of 2022. These guys peaked in Q4 of 2021. So maybe 6 months, maybe 8 months in front of real estate housing. And there's peak number one, and there's peak number two, and it's rolling over. So far, it's down 12.7% on a national basis. So you have to remember, a lot of this stuff is regional. Now, Phoenix just was the worst place in the world for you to buy a piece of property in the great financial crisis. We were just awful. We were a construction town. We had 250,000 workers or 400,000 workers. Just an amazing amount of workers leave because construction stopped. And while that construction was going, it was just really, really fun here. And then it left. And our market just collapsed. That's why we were so bad. When you have 400,000 workers leave, well, then, the apartments go vacant, housing gets soft. There's no one at the grocery stores, at the movies, at the ball games. Everything, it just slows down. And that's what happened here. That's regional. That's going to happen in some big markets like in Florida and Texas, Tennessee. We can see it already. We're seeing that REITs and foreign REITs, we just got that Daniel DiMartino Booth just told us last week that we're seeing overseas REITs are starting to sell out. Now, Europe is a basket case. Europe is they're in a recession, and they are really in trouble. Just Google German autos, and you're going to see that Volkswagen is laying people off. Audi's laying people off. Bosch is laying people off. This is just a really, really bad. And of course, Germany is the economic engine for Europe, and Germany's really having problems. That's coming here. Let me go to my next slide, and then we'll finish this up a little bit so we can talk about this stuff. Let me go. Now, some places around the country now, this has been in the news. So Blackstone owned this building, and it was valued at $605 million 10 years ago. Now, you know that these commercial loans are not good for 30 years. They're good for like 7, 5, 7, sometimes a 10. So it got appraised in April of 2023 for $175 million. Now, it was valued at $605 in 2014, and it was reappraised for $175 million. That's what's happening in some places in commercial. It was down 71%, way below the mortgage. The mortgage was $308 million. And Blackstone made a business decision, and they left. They abandoned the tower. And what's happening is that here's the why. We have a vacancy factor of 19.6% national. And guys, I'm going to tell you something. You're not going to like to know this, but most of the S&P 500 companies are honoring their lease. Once they quit honoring their lease, that vacancy is going way up. And of course, what happens when the cap rates change? Because as interest rates go up, you want to get compensated for your risk. So cap rates go up. As cap rates go up, prices of properties come down. And of course, it's sold on income. And what happens when you're getting a 19% vacancy? It means your income's nowhere near what it should be. And the value of these properties plummet. That's what is happening here. That is going to happen to housing. And people say, well, they have all this equity. Well, yes. But what if the prices start falling? That equity goes away pretty quick. And here's the other thing. A lot of people made a lot of money. And I have to tell you, a lot of people are not fiscally responsible. So when they get $100,000 in equity in their property, they took out HELOCs, they refinanced. And they bought motorhomes and, skidoos and boats, went on great vacations and new furniture and had all kinds of fun. So that equity has been spent. And if that equity has been spent, we're going to have a major problem. And we're already seeing that. So let me go to my slide. So this is where I'm at. We can talk about your portfolio, talk about what you should keep, what you should not keep, talk about looking at, make sure it's income, see how we can reposition it. We're really good at that. We've been doing this for a lot of years. But I'm going to tell you, here's where I think you should really pay attention is that we have a storm coming. That storm is upon us now. And the storm is going to clear up. It's going to get better. And there's going to be lots of damage. Those that prepared with extra cash, reducing their debt, keeping their credit lines good, making sure their income streams are protected, we're going to clean up. We're going to buy these properties. If properties drop, 30, 40%, which I think they have a potential to do that. Some places, maybe even more. But these extremes are going to resolve because the markets hate extremes. And this is coming. So we want to buy it. If you want to reach us, we'll talk about your portfolio, talk about your goals. You can tell me a little bit about yourself, what you want to do, and we can help and put this together. It takes a couple hours to do this typically. Make sure that I'm a good fit for you and you're a good fit for me, but we're going to start doing this. So if you need me, give me a call. My very, very best to you guys. Bye-bye now.